You are watching In Your Interest, and on the show we're putting the conflict and the rising tensions in West Asia. As the conflict between Iran and Israel intensifies, there are growing concerns about a potential full-scale regional crisis, possibly another world war. With Iran being a major oil producer, any deterioration in the situation could have major implications for global crude oil prices. Oil prices have surged for the third consecutive day, with Brent Crude nearing $75 a barrel. Experts have warned that a sharp increase in oil prices could disrupt central banks' plans for rate cuts, as higher inflation might complicate the efforts towards an economic recovery. This rising cost of crude oil is particularly concerning for emerging markets like India, which imports around 80% of its oil needs. With Indian stocks already trading at premium valuations, a prolonged conflict in West Asia could lead global investors to reassess their positions in one of the world's top-performing stock markets. Meanwhile, gold prices have reached multiple peaks this year, outperforming all other asset classes. This surge can be attributed to several factors, including central banks reducing their reliance on the dollar, institutional investors diversifying their portfolios, a strong demand for jewelry among retail investors, and the escalating tensions in West Asia. As a result, gold has soared to record levels. So what's going to happen with gold? What should you do? And what's going to happen with crude oil, and how will it impact India? To understand that, we have some special guests joining us. We have Anindya Banerjee, Senior Vice President and Head of Research, Commodity and Currency at Kotak Securities, joining us. We also have my colleague Suyash Maheshwari with us here in the studio. Anindya, we'll just come to you. Suyash, let's put things into perspective here. Gold is hitting record highs on a regular basis, and this is coming on the back of a sustained period of gold prices going through the roof already. Where is gold possibly headed, Suyash?
Certainly, Krishna, and I mean, how well has gold performed for investors in this year? I mean, we have seen several conflicts play out this year, and as a result of it, I mean, gold, as we know, traditionally it's the oldest asset class, the safest asset class as per investors. So whenever there is any geopolitical concerns, any sort of uncertainty coming into the markets, investors flock to gold, and we are seeing this this time again. And again, as you rightly pointed out, gold has been scaling new peaks pretty much on a daily basis. Now it has managed to outperform most global equities, even Indian markets, which have, by all accounts have had a stellar year. Nifty is up about 16%. Gold has delivered returns of about 20%. And, I was reading some of the brokerage reports. They are estimating that gold could even surpass 3,000 mark in the days to come. Spot gold could, get to 3,200 in this run-up. And, here in India, the prices again are at record high levels. And we have the festive season coming up later, in December, January. Then we have the wedding season also come. So local demand for gold is only also going to go up. And also, let's not forget that, gold prices, the government had cut custom duty on gold prices, which has also resulted in, a lot of local buying for gold. And these are some of the factors that are leading to this rally in the yellow metal.
Right. So gold is shining and shining brighter, continuing to shine brighter. Meanwhile, the fears are always over what's going to happen with crude oil and what's going to happen to our petrol and diesel bills. Anindya Banerjee of Kotak Securities, talk to us. One factor that we all have to keep in mind is the fact that currently over 35% of India's oil needs are being met by Russian oil. And that Russian oil is coming to us at a discount. How do you think this will impact India's oil consumption, India's oil bill overall? The fact that OPEC prices are only going to go up.
Yeah, Namaskar. Thank you for having me. See, the oil prices currently, if you compare it with what it was same time last year, it is still down, because for let's take the last year's average. It was around $80 or so. Currently, the Brent is around 75, the current price. So the current prices are still not reached a level where it will cause an alarm, or let's say it will lead to higher inflation. But yes, if the geopolitical tensions continue to rise between Iran and Israel, then the prices can rise, because we had seen what can happen to oil prices in 2022 when the Russia-Ukraine thing erupted and oil prices went from high 70s to all the way up to even the spike was up to $140. But this time around, things look much more controlled till now. So if things don't really escalate out of hand, we might not see a huge spike in oil prices. But nevertheless, traders are watching this particular incident, and we may continue to see the oil rise in the coming days, possibly 82, 83 dollars a barrel on the Brent, which will be roughly 8 to 10% from the current levels.
Right, Anindya, my question here is that how much of an impact do you think it will have on Indian consumers? Because the fact of the matter is that the oil marketing companies, when crude prices were lower, did not exactly cut prices. So they're sitting on a good cushion, in that sense. Even if crude were to go up further, India is relatively safe considering 40% of its oil comes from Russia, and for the rest, the OMCs have been, keeping the petrol and diesel prices at the same levels despite the crude oil prices coming down.
Absolutely, absolutely. So India is in a comfortable position because we still have the government taxes are decently high enough. So there is enough cushion for the government to lower the rates if the oil prices rise further. So India at this current juncture is not really in a position where it's going to get directly impacted. But again, as I said, we have to keep a close eye, because if the oil prices start to rise beyond, let's say, $90 and head to 100 plus, then things might get a little tricky. And then we could actually see Indian financial flows, they come down, especially from the FPI side, and that can hurt the bond market, that can hurt the equity markets. But as of now, it's not a case for alarm, but something which we have to watch.
Right, Anindya, stay with us. We also have Kunal Shah, Head of Commodities Research, Nimal Bang, set to join us in just a bit to help us understand how exactly will gold move from here on. Suyash, talk to us. This is a contrasting scenario. One is the fact that gold prices going up. It's good in the sense that Indians, they have a traditional penchant for investing in gold. But the problem with the gold prices going up so much is that it's again becoming such an over-expensive asset class that many Indians, it's going out of reach of many Indians.
Right, certainly. And gold, I mean, it's at a peak of what, almost 78,000 rupees, and certainly it's becoming expensive for Indians to lap up gold, especially as we are heading into the festive season. But, Krishna, even that said, the demand has been there. I mean, since the custom duty cut, Indians have been lapping up gold price, and I think that is why we are seeing this, massive spike. Because remember, in the spot market, the spot gold prices are, marginally down, but in our local markets, gold is at record high. So clearly the demand for gold is not subsiding, and with the festive season and the wedding season, just a couple of months down the road, I think it's only going to pick up from here.
Right, and with the way the safe haven buying that they're talking about, Suyash, that's what is happening with gold globally speaking. But for Indians, whether there's a crisis in West Asia or not, particularly considering the timing you're talking about, smack in the middle of the festive season, the demand is only going to go up going further. But the question is that while gold demand goes up and consequently gold prices go up, what will happen to crude oil prices? Because the same tensions impact the price of both. So let me bring this back to Anindya. With gold prices going up because of safe haven buying, so to speak, and the fact that you have a festive season going on in India, how do you see the impact of it, and how long do you think India can sustain without too much of an impact of rising crude oil prices? What is the kind of time window that India is working with?
See, generally, so there are two factors here. One, we are getting the discounted Russian crude that really helped us even during 2022 when the prices were much higher, right? Secondly, we estimate that as long as the oil is not rising above, let's say, $100, we are safe. It's only above $100 things start becoming bad, and we could see the first impact comes from the FPI flows, especially on the bond market side. Because in anyways on the equity side, we did not see much of a flows this year, but your bond market flow starts getting impacted because then the traders start to price in that it will lead to higher inflation. Because now we are pricing in that the interest rates will come down even in India as it is happening outside. But if the oil prices starts to rise above 100, that equation goes for a toss. So that is a direct impact which comes in and immediate. And the economic impact is if the oil prices sustain above 100. Even in 2022, we had a spike to 140, but it did not sustain long above $100. And we were also getting the discounted crude. So again, 100 is the red line. If it starts to go above 100, we have to become cautious both on the consumer front as well as on the financial markets.
It is the red line. As long as we don't cross that, we should be safe. But Anindya, what do you think about how will this spike in crude prices contribute to inflation? Because inflation was just starting to come under RBI's tolerance limit. I think for the last 2 months we have been below that 4% mark, and food prices, I mean, they have been a spoil sport. But oil prices declining in that time was a major contributor to the headline inflation coming back under the control. I mean, how, if the oil prices continue to rise from here on, and let's say we get to that $100 mark, how big of a curveball will it throw to the RBI's plan of monetary easing and inflation picture altogether?
Sure. See, a rough estimate says that a $10 to $12 rise on the India's crude basket leads to around 40 to 50 basis point rise in the headline inflation. Again, there are a lot of assumptions into it. But yes, if oil prices start to hover above 100, then it's going to really throw a spanner, not just on the interest rate story in India, it's for a lot of other central banks, including the Fed. But yes, that's something which we have to watch, because see, how far the inflation will get impacted will depend on how long the oil stays there. Because if it's let's say a brief spike due to the war, and then it comes down in a couple of months' time, then the impact on the inflation front is not that significant. But if the oil prices stay above 100 for some months or quarters, then the impact is much more severe. So that at this point in time looks a little unlikely. We might get a spike if this war really escalates beyond all expectation, but it may not sustain. So that is the silver lining.
I mean, oil and gas stocks took a beating. OMC stocks specifically, they were down somewhere, I mean, by 4 to 7%. Do you think it's a good time to buy these stocks considering the sharp correction that we have witnessed in the last couple of days?
Actually, I'm afraid I don't track the oil and gas stocks. I track
Fair
the
enough.
commodity.
Fair enough. But if for those who are watching this broadcast who do invest in them, if their choice to either invest or continue investing or investing more into oil and gas stocks will depend upon how the entire crude oil big picture plays out, isn't it?
Yes, absolutely, absolutely. Because we have to understand that if we take this war premium which is building up, what has been the oil market situation? It has been actually quite bad in terms of there is much more supply than demand. And OPEC had to actually take almost 6 million barrels of oil per day off the market, and they are still struggling. Yesterday only, there was a statement from one of their members saying that if the compliance is not good from the OPEC Plus members, we could even see $50 oil. So, so the disruption as far as the war is concerned, yes, that's something serious which we have to watch. But if you look at the Iranian oil supplies, around roughly, let's say 3.5 to 4 million barrels, it is significant, but not something like what it was the case with Russia, because that's like 10 to 12 million barrels of oil. But again, we have to keep a watch on what's happening in Iran, but we don't have to get overly alarmed.
Okay. We don't have to get overly alarmed, is the word coming in from Anindya. Anindya, stay with us. We also have Kunal Shah, Head of Commodities Research at Nirmal Bang, now joining us live on the broadcast. Kunal, thank you so much for taking time out to be with us. There seems to be no stopping gold. I mean, Indians, we have that penchant for gold. We are in the middle of festive season. We will be buying more and more in gold. But what is happening in terms of geopolitical tensions globally is driving more and more money towards gold in terms of safe haven buying.
Okay, now let us say hypothetical scenario. If Iran is getting sanctioned by US, the way US sanctioned Russia, and we've seen at the start of the Russia and Ukraine crisis, almost $500 billion of Russia was sanctioned and was freezed. So at this point of time, what Iran will possibly try to do is they will try to add as much as gold possible in their FX reserve. Remember, Iran has been quite instrumental from last 4 months as far as their adding up their gold reserve is concerned. So the entire narrative, the state of the demand is changing. This is a new age demand which we have not seen. Central banks have been buying more than 1,000 tons of gold every year from last 2.5-3 years, and out of this 4,500 tons of market, 1,000 ton is consumed by central banks. So it doesn't seem that this is going to stop. But if somebody wants to buy gold, they should not buy it from the horizon of 2 to 3 months point of view. Yeah, horizon should be at least from 2 to 3 years point of view, because we are already trading, gold is already trading at all-time high. So I am still convinced about the structural bull run of gold. I don't see that abating going forward. But in the near term, we may see some hiccups or some softening in the geopolitical thing, and it can react. That's a different scenario. But I'm still very positive on the overall outlook of bullions, and I foresee by the end of the year, gold is conservatively likely to test $2,800 on CME.
All right, and Kunal, I mean, I wanted to actually get your price prediction on gold because, you know, one of the questions that we get asked most often is that, I mean, at 78,000, how much more can the precious metal rise? But since you have already answered that, what about silver? Is silver something that investors can look at this point in time?
Yes, it looks, see, whenever there is a geopolitical concern like we are seeing right now, it's very inflationary. Okay. This is the time you have to be in commodities, because commodity prices are going to go up significantly as and when the geopolitical scenario continue to worsen going forward, especially in the Middle East and also in the Russia and Ukraine. So I am of the very firm view that silver fundamentally, as compared to the gold, is a better option, and still have a lot of potential going forward to move up significantly. So from last 3 years, we are witnessing a gap of 12.5% between demand and supply. So demand is higher than supply, and that gap is widening constantly. The silver supply is constant from last 10 years. So I believe that silver is a much better option going forward, and silver prices are going to go up significantly. 6 digit is on the cards, and I'm counting more. So this bull run of silver is more fundamentally driven rather than just central banks. Central banks are not buying silver. Gold is something what central banks are buying. And without the support of central banks buying silver, we are seeing silver at almost $32 from 20 and a half dollars 2 years back. So we are going to see a structural bull run, $35 to $36 on COMEX. In India, possibly 1,05,000, 1,10,000 are kind of conservative targets, which we are eyeing in a 1 year's period.
All right, you know, you're talking about central banks. Central banks are increasingly, you know, reducing their reliance on the dollar. They are buying gold. One of the main reasons why being attributed to the surge in global gold prices, there is a global gold price, and there is an Indian price as well. I just want help us understand, how do you see these two? Do you see a divergence in them going forward or a convergence?
I think Indian is going to, the only difference here is the outlook on currency. The way India economic growth stands at this point, it seems that in the longer run, Indian should appreciate. So it seems that the Indian gold prices are going to underperform as compared to the international gold prices. And going forward, as and when our economy evolves and becomes $4.5-5 trillion economy, at that time, Indian rupee will be perhaps somewhere at 80 or 79, somewhere at those levels. So, and that also depends upon the imports of gold and other commodities. So, but my conservative outlook is the rupee should appreciate, and that's the reason why Indian gold, as compared to the COMEX gold, should underperform.
All right, gold is on a structural bull run, and it is expected to, you know, end the year on a high. I mean, at a time when, Kunal, the stock markets are correcting, one of the questions that always comes up is that, you know, how much allocation should you give to gold in your portfolio? What would be, you know, your recommendation? And in that allocation, how much and how would you play it? I mean, how much of it would you give to gold and how much of it would you give to silver?
Okay, the old economic theory always suggests that, you know, whenever the stock market goes up, gold underperforms, and vice versa. Whenever the stock markets are not doing well, gold really performs well. Those theories are not going to work anymore, because we are in a scenario of high liquidity. When the liquidity is too much, everything goes up together. Markets are moving up, gold is moving up, silver is moving up. And when liquidity gets drained out, even at that time, gold tends to underperform. So those theories are not working anymore. Okay, and going forward, what I foresee is that as and when, with the time, gold should be able to outperform some of the indices globally, because the fact is, the way the entire global macroeconomics is standing at this point, the worst geopolitical fear, de-dollarization, the structural weakness in dollar because of massive printing done by them, all the central banks are cutting interest rate, the growth going forward seems to be deteriorating. So it seems that gold is likely to outperform most of the stock indices going forward. And if you ask me what is the allocation should be 15 to 20%. But anyone who is buying gold at this all-time high should not buy it for 3 months, 4 months, or 6 months period. They should have a longer horizon, because due to any reason, let us say the geopolitical conflict subsides, there is a solution, anything happens, at that time, gold will again starts correcting, and you should have plenty of room to average it out. But the horizon should be for 1.5, 2 years. That's the message which I want to give to the viewers through your channel.
All right, we will leave it at that. Kunal Shah, Head of Commodities Research at Nirmal Bang, thank you so much for taking time out to be with us. And of course, Anindya Banerjee, SVP and Head of Research Commodity and Currency at Kotak Securities, thank you so much for taking time out to be with us here on this edition of In Your Interest. And of course, Suyash Maheshwari, my colleague as well. Thank you, Suyash, for being with us. And with that, it's a wrap here from our side. It's a completely run out of time over here. Thank you so much for watching. This is Krishna Kumar signing off.